Welcome to the Tech Exits podcast. In today's Investors Corner, we take a deep dive into where tech investors are putting their money, exploring market trends, founder challenges, and what it really takes to navigate the complex world of tech M&A. Today, we have the pleasure of welcoming Jenny Abramson, founder and managing partner at Rethink Impact, the largest U.S.-based impact venture capital firm investing in female-led tech companies tackling some of the world's greatest challenges. Rethink Impact focuses on sectors such as digital health, education, economic empowerment, and environmental sustainability, backing companies that combine strong business fundamentals with measurable positive impact. Jenny joins us to discuss Rethink Impact's investment approach and thesis, how her team helps founders prepare for exits, and what she's seeing in today's dynamic M&A and IPO landscape. We'll also explore how impact investing is shaping the future of tech, the challenges and opportunities for female founders, and what makes this moment so pivotal for the next generation of mission-driven entrepreneurs. So, let's begin. Jenny, thank you very much for joining us today.
Thank you so much. It's fantastic to be here.
Well, Jenny, to start off, can you tell us a bit about Rethink Impact? What's your investor thesis and which states and industries you're most drawn to?
Well, as you likely know, Rethink Impact backs female-led tech companies who are tackling some of our greatest challenges. We tend to invest in companies as early as a late seed round where they already have some commercial traction and to as late as a Series C will come in, where they're obviously much further along. From a sector perspective, our focus is in healthcare, more digital health than biotech or medical devices, education, economic empowerment, which we often think of as fintech for good, and environmental sustainability. I'm happy to give you an example or two if it's helpful to bring more color to it.
Sure. Let's hear some examples.
I'll use one in the education space and maybe one in healthcare. In education, we invest in a company called Parallel Learning, which offers special education support in schools for students through live online services and assessments that are delivered by expert providers. And this matters because 1 in 5 students have learning differences, and yet 78% of K-12 public schools report difficulty actually filling special education positions, especially those in rural districts. So Parallel is tackling a huge need and is already serving students in more than 15 states. So that's one example. In healthcare and really fintech, we recently invested in a company called Flex, which is a fintech platform that addresses the $6 billion in flexible spending accounts that are forfeited each year, but could otherwise pay for preventive care, which has been shown to reduce chronic medical conditions. So their tech enables businesses to accept HSA and FSA as a method of payment at checkout, which unlocks completely new revenue streams for brands and helps consumers save 30 or even 40% off their health purchases, which is really exciting.
We've seen a big jump in venture-backed tech exits this year, 21% higher in the first half of 2025 compared to last year, according to a recent report from the Quorum Group. From your perspective, what's fueling that rise?
I think there's a few things at play here. First, there's a ton of dry powder in the PE space. I mean, trillions of dollars, some estimate as high as $2.5 trillion. So there's pent-up demand for acquisitions. And while the IPO market peaked in 2021, largely driven by SPACs, if you remember those, it has really cooled off in large part due to inflation. But the IPOs launched this year have been the strongest first half performance since 2021. So given that healthcare is one of our greatest focus areas from an investment standpoint, we are super excited about Amada and Hinge IPOing, but also excited about the M&A market. It's, of course, difficult to predict in the current climate what will come next, but we see this as a really good sign of momentum moving in the right direction.
You've been through different exit waves throughout your career. How do you think this current environment compares to previous exit waves you've seen?
I'd say we're cautiously optimistic. Crunchbase just did a study you may have seen showing that not only are M&A activity and IPOs increasing, but overall values for exits are also up significantly compared to previous years. The IPO listings alone this year, were collectively valued at an IPO price of $86 billion. And that's compared to more like $56.5 billion in 2024. So of course, it's now nowhere near the 2021 peak where every quarter saw over $100 billion in IPO value, but it's moving in the right direction. And, on the M&A side, we did see deal values rise in August of this year compared to last year with fewer and larger transactions. So I'd say it's slightly different because it's more concentrated than it has been in the past, but still is on the increase, which is exciting.
As you know, VCs are involved in more than just raising money. So when one of your portfolio companies is starting to think seriously about an exit, how does Rethink Impact get involved in that process?
Yeah, as a VC, ultimately we wear a number of hats. And a lot of that depends on when we've invested in the company, what their growth trajectory looks like, and of course, the market more broadly. That said, we are big believers that the earlier you as a CEO can build optionality for yourself, whether that's through strategic relationships with, big corporations who could be ultimately acquirers, or having the right financial talent internally as you get closer to an IPO, the better. And because we really want our CEOs, who are just incredibly talented leaders, to ultimately have the ability to control their own destiny. So what does that mean for us? Sometimes that means making the intro to a senior level person in a strategic customer or even a potential acquirer. Sometimes it means that we might help source a CFO for a company, and we've obviously done that. And sometimes it just means having important conversations with the team and the board along the way to ensure people are sort of shooting for the same North Star.
Sounds insightful. Earlier, you mentioned a bit about IPOs. Based on your experience and the portfolio companies you have, are you seeing more exits happening through strategic M&A, IPOs, or secondaries right now?
No, we have found there's no most in any portfolio across our three funds. Every portfolio is different. Every company and frankly, every sector really differs at different moments in time. We have some companies that are exploring M&A for their full business or even part of their business where they have sort of two different divisions and it makes sense to sell one and not the other. We have some that are looking at strategic acquisitions, either by PE acquirers or more traditional strategics. And we have some that are clearly very focused on the IPO path. And so much of a company's success, in our eyes, is being prepared for everything, but being sort of nimble enough to adjust and guide your team and its resources to the appropriate exit at the optimal timing.
On the same topic, with the market shifts and the resurgence of M&A, has it changed how you guide founders on building for acquisition versus IPO?
It's a great question. One of the great things about venture capital is that it's countercyclical. You have a 10-year fund life in most cases. Therefore, you typically don't have to have sort of knee-jerk reactions and sort of change your company's plans based on a given moment in the market. So broadly speaking, we believe that we should be sort of counter to any given moment. That said, there are certain strategic things that you might do to guide founders in different cycles to maximize valuations and access to capital and exits where it makes sense. And, that might be adjusting a burn ratio target in a time where the market is valuing cash over growth at all costs, which we've seen, or building more strategic relationships to ensure optionality in an uncertain IPO market, which is, something we saw especially a year or so ago, and at a time where M&A values have surpassed their previous peaks.
Given that you invest in impact companies, how does that affect M&A potential? Is there less M&A appetite for impact companies?
I think the short answer is it depends. And in our case, no, it doesn't. And I'll talk to you about why. I think there are many kinds of impact companies, but the type we invest in, the impact doesn't negatively impact M&A potential. It actually probably increases it. So let me unpack that for you for a moment. Impact is a broad term. It can be anything from a company giving away a percentage of its profits or products, like think Tom Shoe's motto created, to being embedded. Impact can instead be just embedded in the core business itself. In the case of Rethink Impact's investment thesis, we only invest in impact businesses where the impact is embedded or actually grows with revenue and with profits. We call these convergent business models, and we like the fact that focusing on strong fundamental business economics and unit economics drives the impact. So when times get tough, no one has to debate whether to keep the impact. And when new investors come in, there's no risk that the impact gets stripped out. It's sort of part and parcel with the economic model. So if anything in these kinds of businesses that we invest in, the type of impact we do at Rethink Impact, we find that the impact not only isn't a detriment to returns, but can actually enhance them for all sorts of reasons, not the least of which is attracting the best talent, which wants to be at companies that are having a positive impact on the world. So, as an example, we invested in a company called Wellthy, WELLTHY, that's led by Lindsay Juris Rosner, which is actually tackling the caregiving crisis in our country. 1/3 of employees left a job due to caregiving responsibilities that they had. I mean, it's a huge number. And how Wellthy does this is they partner with employers to support their employees as they navigate these caregiving responsibilities. That may mean helping employees find appropriate care for an aging parent or a special needs child, or even a seriously ill spouse. And Harvard Business School did a study on Wellthy's business and actually found that customers saw more than a 3.5x, it was I think 3.6x return on investment for every dollar they spend with Wellthy. So for us, this is a great example of not only a strong growing business, but one where the more the core business grows, the more the impact grows as well, which of course would have no detrimental impact on M&A activity.
There are always challenges when aligning perspectives. How do you navigate misalignment between founders and VCs on exit timing or valuation? How do you handle those situations when they come up?
Yeah, it's a good question. I think one of the things that we do, and we've been doing this, frankly, a lot more recently. I think early on it wasn't something we were purposely into, but is we really try to be transparent at the time of our initial investment with the CEO or the founding team on how we've underwritten the business and what that means in terms of the growth and ultimately the returns that they need to have for their company for the investment to have made sense for us at Rethink Impact. And I think when we started doing this work, we would do all that analysis to invest in a company, and we would try our best to support them through all the stages as we do now. But more recently, we've been trying to just be much more open and transparent about how we underwrote it right from the beginning. And that may mean walking through the returns analysis that we need and what's the timing and how does that impact it? Because these are brilliant CEOs. And I think when they understand our perspective and what we're focused on and our goals, usually they are very excited to not only have that transparency, but to be able to know what we need to achieve and what they need to achieve. And they get it because they obviously have their own investors and shareholders. And so do we as venture capitalists. And to the extent that there could be misalignment along the way, it becomes about trying to have the important conversations early enough in the process so everyone knows where everyone else is coming from. And especially for us, in our case, where we care so deeply about the businesses and the founders being successful, and we care about our commitment to our own investors backing this important work. So that's a lot of what we are doing to try to ensure that down the road, those conversations are always productive, and you can sort of get alignment much more easily.
Markets are always evolving and changing. Which sectors or technologies are you most excited about and why?
I don't know how many hours you have for this podcast. I can talk about a lot of exciting areas, but we are excited about a few things. I think whether that's solutions that help workers and employers keep up with the massive labor dislocation from AI, to tech that's delivering better public services and improving environmental sustainability, to products that are tackling the massive inequality in women's health. Speaking of that, we literally just announced, it was in Forbes last week, a really exciting new deal called 7 Starling. That's a great example of this women's health issue. And it's focused specifically right now on maternal mental health. And I can give you a couple stats that may blow your mind on this. Despite the massive numbers of women who experience perinatal mood and anxiety disorders, 75% of those who are diagnosed literally never receive treatment. And this is baffling, given that suicide is the leading cause of maternal death in the first year postpartum. And so 7 Starling for us was really exciting because they deliver virtual mental health services across 18 states already, and they've seen a 90% clinical improvement in the patients they serve. So they have over 100 million lives covered by insurance and Medicaid. And for us, it's such a great example of a technology that we're excited about because it's in a space that desperately needs innovation. And that's just, the beginning, but there are many other areas we're excited about as well.
Those sound like very challenging problems to try and tackle. I think it's great that you're trying to make this impact on issues that people normally won't see. Jenny, we're almost wrapping up here, but to hear some final insights for our listeners, we've talked about the pace of exits. Do you think this elevated pace will continue into next year?
Obviously, there's a lot of factors that may impact that, from tariffs to government shutdown. Yes, I live in Washington, D.C., actually, so that's looming very large right now. We expect, and interest rates and everything else will have an impact, obviously, into 2026. But that said, our fundamental belief is that the market will ultimately reward great companies that are focused on strong unit economics and fundamentals more broadly. And given that women spend, female CEOs spend 25% less each month in terms of their same size businesses than their male counterparts, so incredibly capital efficient, we feel like the time right now sort of is really right for strong, great female tech leaders and their diverse teams, male, female, and every other way, to use tech to build incredible businesses that will really become the massive behemoth businesses of our future. So we are incredibly bullish, incredibly excited by the Rethink Impact portfolio, and thrilled to be talking about it with you today and to watch these businesses continue to be the success that they are in 2026 as well.
Final question. What is the smartest move founders can make now if they want to take advantage of these changes?
I think one is really thinking about strong fundamental unit economics. 2, if we can be helpful, someone has a tech business in one of our sectors with commercial traction, we have office hours at Rethink Impact on our website that you can sign up for. And 3 is really leaning in and focusing on using tech to solve problems that they're incredibly passionate about, because we believe they're more likely to have success as a business if it's also something they've experienced or care deeply about personally. So I couldn't be more excited. I'm grateful you had me on the show, because we are so excited about the work that our whole team is doing.
Thank you, Jenny, for your wonderful insights. I'm sure that your outstanding experience will inspire our listeners and help other entrepreneurs understand the perspective of investors on M&A.
Wonderful. Thank you so much.
Thank you for joining us today. Are you considering selling your tech company? Head over to quorumgroup.com, our tech exit sponsor. If you'd like to learn more about selling your tech company, join us at one of our Tech M&A Masterclass events. Attendees of the Tech M&A Masterclass will gain practical knowledge on how to achieve the maximum valuation for their company gained through expert-guided workshops, hands-on exercises, and M&A case studies. Our next Tech M&A Masterclass will be February 18th through 19th at the Aria Hotel in Las Vegas. Hope to see you there. Head over to WFS.com for more details. We'll see you again for the next episode.